He's a graduate of Oxford University. In addition to having successes as an entrepreneur selling one of his businesses to a company owned by Bill Gates, Jonathan is the founder and current owner of Variant Perception, which is a macro research group that provides research to asset managers. One of Jonathan's expertise is understanding bear markets and the leading indicators to help asset managers understand how to position themselves appropriately. So on today's show, that'll be our focus. And without further delay, here's our interview with the thoughtful Jonathan Tepper.
You are listening to The Investors Podcast, where we study the financial markets and read the books that influence self-made billionaires the most. We keep you informed and prepared for the unexpected.
All right. Hey, everyone. Welcome to The Investors Podcast. I'm your host, Preston Pish, and as usual, I'm accompanied by my co-host, Stig Broderson. And like we said in the introduction, we're here with Jonathan Tepper. So, Jonathan, how are you doing?
Doing all right, thanks. Thank you so much for having me on your podcast.
Well, we're just thrilled to have you here, Jonathan. So, you're an expert in bear markets. And with all the talk in the current economy about a potential bear market, we're really excited to talk with you today about some of your insights. So, my first question that I have for you is about some of the research that you've been recently conducting that Stig and I have been reading through. And in your research, you talk about various factors that typically indicate the start of a bear market. 3 indicators specifically are a peak in mergers and acquisitions, share buybacks, and IPOs. Talk to us a little bit about this research.
One of the things that we've done over time is write what we call our understanding series, or you could think of them as white papers. And these are really to try to sort of describe, for example, recessions or bear markets or emerging market crises. And so what we try to do is to go away and study what happens in all of these different episodes and try to understand what's happening from a fundamental economic standpoint, what's happening from a technical market standpoint, what's happening from a corporate standpoint. In market cycles, generally, stock prices lead CEOs and CFOs to behave differently. So in a downturn, when stocks are cheapest, you'd think that CEOs would be very interested in buying back their own shares, and that would be the smart thing to do. And certainly some very smart CEOs do that. And, Buffett has recommended in the past, people like Singleton from Teledyne, so there are people who have executed buybacks very thoughtfully. But what generally happens is that when stock prices go up a lot, M&A goes up, people use their stock as currency, CEOs become confident to buy back their stock. When stock prices start going down, they do the opposite. And so this corporate activity in essentially equity markets tends to be very pro-cyclical and very reflexive. So, higher stock prices lead to higher buybacks, even if they're a misallocation of capital. What's very interesting is that normally these capital market activities are very high and then roll over near peaks. So you would have seen that in sort of 89, 90, 99, 2000, 2007, 2008. And what we've seen is a huge surge in all of these. Buybacks remained very strong. That was primarily driven by the tax changes that we saw over a year ago.
Very interesting. So we talked about mergers, acquisitions, share buyback, IPOs, and whatnot. And there are many different indicators that might have a correlation. But I would really like to talk about the difference between correlation and causality, because it's 2 different concepts I think are very interesting for investors to get to know. Perhaps if you could explain the difference between correlation and causality, and then talk about what has the highest impact or causality to a bear market if you look at some of those indicators.
Correlation and causation are 2 totally separate things. As GDP growth happens, for example, you end up with more streets generally and more streetlights, right? Neighborhoods grow, cities grow, but an increasing number of streetlights in a city doesn't lead to higher GDP, So there are certain things that you could correlate very, very well. And, one doesn't cause the other, right? It's the opposite, in fact. Higher growth tends to lead to streetlights, not the other way around. And so you certainly find this with stock markets. And so, just because you see something moving in the same direction doesn't mean it causes that. What we try to do is to find leading economic indicators, so things that do cause economic growth or markets to turn up or down, where there is a lead, meaning that it gives you as the investor or policymaker 3, 6, 12, or even longer 15 months to see what's coming. And so one of the reasons why we had been very cautious and negative was that a lot of the leading indicators that we had concerning global liquidity had turned down. And that is causative, does have an impact. When money is tighter, it tends to be more difficult for stocks to go up, and it tends to have a negative impact on market economies. And so everyone right now is fairly aware that China's had a bear market. The Chinese economy is certainly slowing. I mean, the GDP numbers are fairly made up. Basically, it's like 6.6, 6.7, 6.8%, which is just absurd if you think of such little variation in GDP from one quarter to the next, when you're seeing such wild swings in industrial production and capital markets. A lot of the leading indicators that we had for China and a lot of the indicators that we had for global liquidity and even Europe were fairly negative. And so that was one thing as well, in terms of sort of money and financial conditions, which we thought would cause there to be problems in equity markets.
I know it's difficult to go in like pinpoint just one factor. We're talking about financial markets. It's more than an art than a science. But I'm curious to hear like which indicators do you look closest at, and does that really depend on where we are in the cycle?
There are some indicators that are certainly more helpful than others. And if you went to a desert island, which indicators would you take? We could narrow it down, and we certainly do. Each recession tends to be slightly different. For example, in the 2000-2001 recession, U.S. retail sales really never went negative. Part of that was you had a huge interest rate cuts. The housing market was taking off. That was unlike almost every other recession. So if you had simply focused on that one little thing, you would have been thrown off, right? What we try to do is look at a variety of things. But I think if you had to narrow it down to a very few set of things, one, initial unemployment claims almost always rise going into a recession. Sometimes the lead is longer, sometimes it's shorter. But initial unemployment claims are extremely important. At a minimum, a confirmation when it leads by 2 to 3 months. Sometimes it leads a little longer. We generally look at very flat to inverted yield curves. And the U.S. typically has had an inverted yield curve before recessions. I don't think, by the way, that inversion is absolutely necessary. That's been the U.S. experience in the past. There have been many recessions without inversions, and I think the lower the level of interest rates, the less likely it is that you're going to get an inversion. And that's just, because sort of front end can't rise too much relative to back end. I think it's important, and it's very significant, and we do track that. Those are two that I think are very important. And then certainly credit spreads are certainly very, very significant, right? If you think about it intuitively, and getting back to your point, it's a cause as well, but it's also reflexive. Credit spreads, when they're widening, CFOs are not very confident about investing or about hiring people. They're worried that their company's not going to get funded properly, right? And so credit spreads tend to lead initial unemployment claims slightly. They also tend to lead industrial production. And so generally, whenever credit spreads are widening significantly, it's telling you that something, credit and risk are being repriced. It's more difficult for companies to get funding, and then they're going to be more reticent to invest and to hire people. So I would say those are probably the three that I would pick. And then there are many others that we look at and go into our model. One thing I would say is very important is that many people think that the economy sort of moves very smoothly from growth to contraction and back, right? And so like this wave-like pattern, thinking that you're going to get this very long advance notice. But generally, from our research and experience, it's much more like water boiling, right? Where it is similar, actually, going from ice to water. You have a pretty abrupt transition point, and then you also have a pretty abrupt transition point from liquid to gas. And so these are phase shifts rather than sort of this smooth sort of wave-like, where it's slightly water, slightly gas, or slightly ice. These are phase shifts. And so a lot of the models that we have essentially look at the shift from growth to non-growth.
So, Jonathan, one of the things that you've talked about twice is the idea of reflexivity, and which this is an idea that's most commonly tied to billionaire investor George Soros. So can you explain to our audience what reflexivity is and why it's so important?
When prices move a lot, you often do tend to end up with people taking the opposite view. But in general, I would say higher stock prices lead to higher stock prices, lower stock prices lead to lower stock prices. And part of this is the term reflexivity, which is that even though financial assets, whether it's corporate bonds or whether it's stocks, they actually influence reality. And so Soros talked about how, for example, he writes about it a lot in The Alchemy of Finance, but if a stock price is going up, then you can use your own shares to buy other companies. You can fund yourself more cheaply. If your stock price is going down, people are worried about your company. They're less likely to lend to you, right? And so in a way, that what's happening in the financial markets is then feeding into the ability of the company to do itself. And all it is a stock price. It's like a line on a screen, right? It's very interesting that you can then have a stock market decline or widening of credit spreads, which then leads CFOs and CEOs to make changes to their behavior. in ways that almost make it more likely that stock prices are going to go down, right? So just imagine if the stock prices are falling, CEOs then decide to spend less money in CFOs, then people start getting laid off, which leads to more stock prices fall. And so that's a reflexive process, right? And the same is true in reverse, meaning as the stock market goes up, people feel more confident, they invest more, which means the economy is healthy, which means the stock prices go up.
Thank you for that explanation. I just wanted to give a quick handoff for the listener. Preston and I did a book review of The Alchemy of Finance, the book by George Soros that Jonathan just mentioned. I'll just link to that in the show notes. But I think the concept of reflexivity is very important to understand, to grasp in the financial markets. It's also an underlying theme here for this segment here of the interview. It's kind of a nice segue here to my next question, Jonathan, which is about bear markets. But because whenever we think about bear markets, we often think about recessions. 2001 and 2008 probably comes to mind with a lot of the listeners. Many of the indicators that we look at right now, we have low unemployment. We've also seen slightly higher real wages, which is something we haven't seen in the US for a long time. A lot of that signals that the economy is strong. Now that I'm speaking to you, Jonathan, and I know you're much deeper into this than me, do you think the economy is strong? And can we have a bear market even with a strong economy?
The normal definition that we use for bear market is a 20% decline. So that's one that we have used and stuck to. And you could look at 20% on a closing basis, but obviously stock prices can be very volatile on an intraday. And so sometimes if you're looking historically at market declines, some of them look like 19% declines, by the end of day, but actually were much worse given the high volatility. If you go back over the last 60 to 70 years, there were many bear markets that exceeded 20% or were, within intraday and even on a closing basis where there was no recession. So, for example, 1946, 1961, 1966, 1976, 1987, and even 1998, if you're looking at that on an intraday basis. Those are cases where there was no recession and you had a bear market. Those were generally either between 19 and 30% declines. In the case of 87, for example, it was a 34% decline from peak to trough. It doesn't necessarily imply that you are going to get a recession. When you have bear markets with recessions, that's often where you end up with your deepest declines. So, for example, in 1968, you had a 36% decline. In 1973, you had a 48% decline. It's basically the 50%. And then in 2000, 2007, you ended up with around 50% declines from peak to trough. And so declines and drawdowns tend to be much worse when you're in a recessionary state than in a non-recessionary state. And then generally, when you're not in a recession, those episodes tend to be, obviously all of these drawdowns are buying opportunities, but in a recession, the drawdown might just continue a lot longer, over the short run if you're buying.
I would say that for most people and for most investors, it would make sense to say that if we have a recession, the stock market drawdown would be more significant. But what is the intuition behind you can still have a bear market even with a strong economy? Because I think most of us would think that the stock market is reflecting, economics. If that's good, why wouldn't the stock market perform well? Since after all, it's the profits from the corporation that's flowing back to the investors.
Certainly. So if you look at the last 40, 50 years, I gave a few examples, but there are periods of time where stock markets have gone up quite a lot, valuations have increased. And so what you end up with is a correction, often based on higher oil prices, higher interest rates. The 1987 crash was an example. 1966 was very similar, where you had a lot of the Nifty 50 stocks, where people were buying them based on momentum, and that was a 22% decline. So often you do end up with essentially, these could be viewed as being healthy corrections. The 87 crash was 1 year after the 1986 tax break, or tax reform. People were very, very excited that there was tax reform. The market ran up significantly. And last year was also 1 year after the tax reform, right?
It was very interesting also this time around, and you heard people talking about the stock market is soaring because of the tax reform, but you kind of heard that argument so many times, you're like, how many times can you really price in those tax breaks, which was very interesting to see from the sideline.
Absolutely. It's similar now where you end up with headlines about resolution to trade with China. I don't know how many times the markets has rallied on that, but markets are not always very rational.
No, I mean, that's absolutely for sure. So Jonathan, in your research, you expand on the idea that as markets go up and down, the average bear market lasts for about 18 months, and it has an average decline of about 42%. As we obviously know, forecasting is extremely difficult, but do you feel like you're able to potentially understand the probabilities associated with the magnitude of some of these declines particularly when you're looking at future forecasts?
The answer is no. Part of that is that each one is different. I do think that starting valuations are important. That is a very useful yardstick in terms of guessing, or having an approximation as to whether the decline is going to be very great or not. Lower valuations tend to have lower drawdowns, but then again, you did end up with some 50% declines in the 1970s, and a lot of that was due to higher inflation and higher interest rates. So even there, where valuations were at a lower base, you could still end up with significant declines. Certainly, having recessions versus non-recessions, which we just mentioned, that has an impact. I would say that the worst possible combination is high valuations coupled with recessionary conditions. One of the interesting things about bear markets is that often there's a sector or two that have been the previous leaders or that have taken on all the debt previously that either get wiped out or that have very significant declines. So if you think of the 2000 to 2003 bear market, that was a sort of information technology. And so you had this massive boom, overinvestment in IT, and people were right that IT was going to change the world, and they were right that the internet was going to change things. But a lot of sort of marginal companies got funded that probably shouldn't have. A lot of good companies overinvested, assuming this sort of exponential demand. And, if you think of the sort of 2007, 2008, you also had quite a lot of boom in the financial services and mortgage lending and banks. And there was this idea that this time was different, that all these banks were sort of better run and they could carry a lot more leverage. And so there's generally a sector that predominates and ends up blowing up. But what's very interesting is that within some bear markets, there are some sectors that will still do well and go up. I started working at SAC Capital in 2003. And at the time, believe it or not, they were referring to home builders and retail and others as the old economy stocks. So that was like you had people who looked at financials and you had people who looked at tech. And I was like working with some of my colleagues, on the old economy stocks. And that gave you an idea just how unsexy those stocks were. But those stocks actually didn't really go down very much in the bear market because they never really went up in the late 90s. And so you could find a lot of very cheap stuff that would go up. The dispersion in sector returns also tends to matter. If all sectors have gone up a lot, then, most of them are going to go down. But that's not always true for everything.
Let's transition back into the discussion about bear markets. One common misperception that we hear is that everyone is selling in a bear market. You might make an argument that you have more sellers than buyers in a market. It does stand to reason that before you can make a trade, you need both a buyer and a seller. Whenever we see a bear market, who's buying when everyone is selling?
There can be more sellers than buyers, in which case that they're frustrated sellers, i.e. they can't sell, right? They need a buyer to take it off their hands. Generally, when you have these sort of frustrated sellers, is that they then start reducing the price that they're willing to accept for their shares. And generally, when there's a vast disagreement, you end up with huge price moves where the price has to go down to induce new buyers to step in to match the buyers and sellers. But as you said, for every buyer, there is a seller. For every seller, there is a buyer, right? And the truth is, if you think about it, also, every stock or bond is held by someone at every point in time, right? There's never a point in time in which a share of a company is not owned by someone. Because of that, what happens in sort of secondary markets, which is like the stock market or corporate bond market, what's really happening is stocks are changing hands. Some people own some shares and they decide in a bear market that they don't want them, and someone else decides that they're going to step in and buy them. In financial markets, there's an expression, sort of dumb and smart money. I don't know necessarily that dumb money sells in bear markets, but you could argue that they do, meaning that people who panic sell when prices go down, and longer-term investors or investors who are happy to put money to work who previously had cash are able to step in and hand over their cash to the people who previously owned stocks, and the ownership gets reversed. I think that if you look at who are the buyers in downturns and bear markets, from my experience speaking to people and even research, generally what you have is people who run automatic portfolios that need to rebalance. So people who were overweight bonds versus stocks tend to reverse their holdings just to keep their allocations the same. Or you find that family offices who may have been sitting on a lot of cash, or endowments who had very high levels of cash, are able to bring their cash balances much lower. And then retail, if you look at like the Charles Schwab survey of their own people, they basically had 75% in equities, I think, in like 2007 at the peak. And then they were 50% in cash at the 2009 bottom. a lot of bonds and almost no equities, right? The retail people are the ones who panic and dump stocks and sell to more patient, longer-term investors.
So, Jonathan, you've obviously done a ton of research and you've experienced bear markets as an active participant and an active investor. But what is the most misunderstood concept about bear markets and why?
We touched on it earlier, which is that in bear markets, not every stock goes down. Not even every sector necessarily goes down. That sometimes is the case, but not always. And it depends on bear markets. And in some bear markets, other stock markets around the world are doing well. Once people understand that, then it doesn't, you don't have to, particularly as a retail investor, go 100% to cash. You can own high quality companies. You can sit it out. And the other thing, I would certainly say is that panicking once the bear markets have started is a recipe for being the dumb money at the table. This is selling your shares to someone who's more patient and happy to take your shares from you.
So, Jonathan, for people that are listening to the show, they may agree or disagree that we're moving into a bear market, but let's just assume for a second that they agree with the narrative that we're moving into a bear market. And if that's true, having a long position is difficult to conduct. So I'm kind of curious what your recommendation is for people, how they can take this defensive position and maybe a long position.
If you look at the latest two bear markets that we had, which was sort of 2000 to the ultimate bottom in 03, or 2007 to 09, there were multiple sort of 10, 15, even slightly higher percentage rebounds within this very big 50% decline, right? So bear markets are brutal for longs and for shorts. Trying to day trade these, at least for the average person, is likely to mean a significant amount of pain, unless they happen to be phenomenal day traders and have, be able to measure sentiment pretty well. But it's pretty brutal. The declines are severe and the rallies are severe. I mean, just look at December versus January, right? You had sort of about a 20% decline, peak to trough, and now we just had sort of a almost 15% rally on some indices. And believe it or not, that's not abnormal. We've seen similar moves in 2000 to 2003 and 07 to 09. You do end up with very serious counter-trend rallies. In terms of shorting the market, that is possible. Generally, the earlier you do it, the better. Part of that is that, for example, once recession starts, stock market declines become pretty severe, but the stock market itself is a discounting mechanism. And generally, the market's already falling 2, 3, 4 months before the recession starts, right? So if you're waiting for absolute confirmation that things are terrible, at that stage, much of the losses are already present. And interestingly, the financials, material stocks, and technology stocks generally have already been declining, most severely into that, which is exactly what we've just seen. I would have a warning to people not to try it at home. Most people are not very good at identifying bear markets before they start. It makes an enormous amount of difference whether you're overweight cyclicals versus defensives, consumer staples versus discretionary. Last year, our call broadly for most of the year was correct, which was we were telling people to be shorting the cyclicals, long the defensives, and it was a trade that worked out incredibly well.
Jonathan, I'm curious to hear about your own experience. Do you have a good story about shorting a position and the investment thesis behind that?
Sure. I had been working as a prop trader at Bank of America. I left. It seemed like a very big bureaucratic bank, and I did not want to stay on the prop desk. I was trying to get them to get me permission to short a lot of the subprime lenders and some of the ABX tranches. So my biggest position in 2007 was Countrywide Financial, and I had puts that were very far out of the money, made a decent amount of money. So the trading was good. A lot of the companies that I bought puts on and shorted ended up going bankrupt and going bust. And then in 2008, I was short all the Irish banks, all the Spanish banks.
You shorted subprime in 2007, and it might be evident to us today and to be like, oh, of course. But not a lot of people did that at the time. What did you see back then?
Quite a huge surge in building permits. There was a very big increase in mortgage lending. What was also present was bad lending in the sense that there were, you had like negative amortization loans, interest-only loans. So people who shouldn't have been getting credit were getting credit. You had very low FICO scores. So all that was present. Timing obviously was a key issue. I did lose money in 2006 putting on some of these trades, and then they all started working out in 2007. And so timing was critical. The 2007 was really where the reset wall hit, and that's where things started to take off. And I thought if you could short some of the lenders, they were the ones that were lending to bad people. And so for a long time, they did pretty well. And then a lot of them just blew up overnight because they relied on financing that wasn't long-term or sticky.
Whenever you're sitting there and you're thinking, I should short subprime. How do you look at the timing aspect? Because even if something is ridiculously overpriced, that doesn't mean that the market realized that tomorrow. How did you think about the position size on that in terms of how much money you had, how sure you were in your conviction about what's going to happen? What was your thought process about that shorting approach?
Well, at the time I was doing it with my own money. I was not doing it as part of a portfolio. I think if you're doing it as part of a portfolio, you probably make very different decisions than you would if you're managing your own money. In that case, it was quite clear that a lot of the leading and liquidity indicators were deteriorating significantly. You'd already had a significant inversion of the yield curve. A lot of the things that I was looking at told me that the economy was going to slow down significantly, and the housing market itself was already starting to implode. I would track all the local news stories in the U.S. It was quite clear that there were defaults starting to crop up all over the place, unpaid property taxes, all sorts of stuff was already happening. So the story was already unfolding. And because of that, I probably made it a much bigger size than I otherwise would. If you're doing it with a large portfolio, obviously you don't just bet it all, not that I bet it all on red, but you try to have a much more sort of risk management approach in terms of position sizing and sticking to, whatever the pre-agreed position sizes are.
Well, thank you for sharing that story, Jonathan. And I am sorry to ask the rude question of, do you have any bad experiences with shorting and why did it go wrong?
Sure. So in 2006, a lot of those very same trades didn't work that well. And some of them were buying, shorting or buying puts on companies that ultimately did go bust about sort of 6 to 9 months later. So the good thing about being long is that you can be wrong, quote unquote, for a good period of time before the market agrees with you, right? If it's a good company, it's going to be earning cash and it's going to be a going concern. The problem with shorting is that, and particularly if you're using puts, is that your timing has to be much better. One of my close friends is John Hempton, who I think is one of the best short sellers in the world. He has his blog, Run to Capital. I'd encourage your listeners to read it. But he shorts a lot of bad companies and often frauds, and he's written about them in the past. And as he points out, if you're lying about having 1 million ounces of gold in the ground, what prevents you from lying and saying that you have 10 million ounces of gold in the ground, right? Like there's no physical limitation when you're lying. And so the problem with a lot of shorts is that you have a very dedicated management that wants to make their stock price go up. If you look at even Valiant, which was doing Medicare, Medicaid, and insurance billing fraud, a lot of the short sellers wrote about it, identified it, were letting the public know about it on their blogs. The stock doubled, right? And then went down 90%, right? And so your shorts can go against you for quite a long period of time before that happens. And even, getting back to the main subject of the podcast, if you look at, for example, the NASDAQ in 99, 2000, a lot of these companies that ultimately went bust, went up many times, even in the last 12 months, right? Anyone shorting these companies that ultimately went bust, would have lost their shirt. And so there's a very good book about shorting written by Scott Fearon called Dead Companies Walking. And, he points out that waiting for the stock price to turn due to reflexivity is a better strategy than trying to short them as they go up, just because it becomes more difficult for them to fund themselves. It becomes more difficult for them to do what they're doing when the price is turned. And so shorting can be very painful if you do it too early.
Very interesting. And I think that a company like Tesla, what we're looking at right now at least, would be one of those examples. We talked long about the company's not making any money, they take on a ton of debt, they keep issuing shares, and the stock price just, skyrocketed. Then there's all these problems with Elon Musk and whatever he was not supposed to say, but it was kind of like whenever it flipped, then it really, really flipped, and it had a really hard time. It was really struggling with the stock price ever since, because of the market perhaps losing faith in both management and in the company. Enough about shorting, at least for now. Most people in our audience, they're long-only retail investors. And we hear from a lot of our audience that they think that the stock market is overpriced too. They would not like to be 100% in cash, like most investors prefer not to. How can long-term only investors take a defensive position if we assume that a bear market is to come?
I think that one of the most important things you can do if you're a long-only investor, is not panic when the market's going down, meaning that if you own the index and hold longer term, you'll probably do well or better. But secondly, own higher quality companies. The companies that tend to go bankrupt in downturns, were like a lot of the technology companies that didn't have stable business models, couldn't produce free cash flow, a lot of the highly leveraged financials. At Variant Perception, for example, we've written 2 big reports recently, one on sort of the shale, basically anticipating the shale bust, and then biotech companies and frauds. And these two sectors share something in common, which is that a lot of these companies basically can't generate enough cash internally and often have significant liabilities outside. And so if you can avoid companies that are likely to go zero, right, you're going to do yourself a favor. And so Buffett, he generally tries to find companies that they don't depend on the market to fund themselves. They can fund themselves internally. And these are not companies that have very significant liabilities generally. And so I think if you can avoid, it goes back to something that I talk about often, which is in investing, it's not trying about making the maximum gain. It's about essentially minimizing your maximum loss. And so that's why Buffett and even Seth Klarman talks about the margin of safety, right? What you're trying to do is avoid blowing up rather than being a hero and making tons of money. John von Neumann created the minimax theorem, and it was saying that people try to minimize their maximum loss. And the example he gave was, if a mother gives a piece of cake to two children, and one cuts the cake and the other picks it, you end up with like almost a perfect division, right? Like the kid's thinking about not, minimizing the chance of ending up with a small piece. And I think when you're an investor, you have to think the same, right? Are you buying terrible shale companies that have billions of dollars in debt, don't generate enough cash? Or are you buying a company that it generates free cash flow? And even if a bear market comes around, it doesn't really matter.
Jonathan, I thoroughly enjoyed this interview and hearing some of your comments. We're just so thrilled you agreed to come back on the show. And as you obviously know, you have an open invitation to chat with us anytime again in the future. If our audience wants to learn more about you, where can they find you?
Thank you so much for having me on the show. It's an absolute pleasure, as always. I would recommend, if the listeners enjoyed what they were hearing, there's a lot more that we've got in terms of white papers and obviously the sort of ongoing market commentary. Go to variantperception.com, and particularly if you're a hedge fund, family office, or institutional investor, get in touch and to request a trial or an access period to see if the research suits your needs. So it's variantperception.com. I wrote the book, The Myth of Capitalism, last year with a friend and colleague that you can find on mythofcapitalism.com. So it's mythofcapitalism.com, the website. It's got loads of good stuff there. And personally, I tweet at jtepper2, and my own personal website is jonathan-tepper.com. So jonathan-tepper.com. Those are the three places where you can find us. And Variant Perception is also on Twitter. And if you want to get beautiful, wonderful charts with leading relationships that can help you trade and invest, just look for Variant Perception on Twitter. And it's, I think, VRNT Perception on Twitter.
Thank you so much again, Jonathan, for coming on the show. We definitely need to do that another time.
Well, thank you.
That was all that Preston and I had for this week's episode of the Investors Podcast. We see each other again next week.
Thanks for listening to TIP. To access the show notes, courses, or forums, go to theinvestorspodcast.com. To get your questions played on the show, go to asktheinvestors.com and win a free subscription to any of our courses on TIP Academy. This show is for entertainment purposes only. Before making investment decisions, consult a professional. This show is copyrighted by the TIP Network. Written permission must be granted before syndication or rebroadcasting.